Hi, you're watching Investor Insights. I'm Vic, and in today's discussion I would like to talk about calling the Fed's bluff. Now, I came across this article which I've put in the description box from Bloomberg, and it was talking about how a couple of days ago Stanley Fischer got appointed to be the vice chairman of the Federal Reserve underneath Janet Yellen. And it's just another name, but if you look into it, this guy taught both Mario Draghi and Ben Bernanke. So if you expect policy to change, if you expect anything new, and if you read into the title, this is actually going to be the focus of this discussion. The title, as I read it, is Fischer as financial statesman may help Fed smooth QE unwinding. Now, this quantitative easing unwinding, or the so-called exit strategy, is a bluff. If you've seen the previous videos about perception, impressions, and reality, it's all about, again, setting an impression that they are going to unwind, but the reality is that it's just a bluff. And this bluff is probably the biggest bluff in the history of the world financial system. Now, let's first things first look at what this bluff, or this great unwind or exit strategy, is supposed to be. Well, they've got Fed's funds rates at an emergency all-time low of 0 to 0.25%. And they have aggressively purchased assets to clamp down on bond rates so as to, well, first things first, help the government be able to sustain their borrowing, and secondly, to try and keep mortgage rates low so people believe that this fast can keep on going on for a long time, and they just keep on trying to inflate this already deflated housing market. So basically, the balloon's burst, but they're just trying to blow a little bit of air back into the market. Now, with half the mortgages in the States still underwater, good luck to them. So anyway, let's look at this exit strategy. Now, the two components of it, as I said, low Fed's funds rate. Well, if the Federal Reserve decided to hike the Fed's funds rate, so the money that it lends to the banks, well, what's going to happen is the banks will pretty much collapse instantly. Because we all know how the banks make their money. It's not from investment banking, it's not from mergers and acquisitions. Look at how many mergers and acquisitions there are right now. That's to tell you how top heavy this market is. Nobody's buying anything because there's no value out there. Now, yes, you have exceptions like Google, who just spent 3.2 billion or something on some no-name, who cares. But 3.2 billion when this company is worth hundreds and hundreds and hundreds of billions, what difference does it make? And it's got $60 billion in the bank. It's no big deal. It doesn't need any borrowings. It doesn't need anything. Google, Apple don't need loans. They don't need to issue bonds. So if the banks make the bulk of their income, probably over 95%, through borrowing at the Fed's funds rate of close to 0% and using it to buy bonds, treasuries, which means that they're lending money to the government at roughly, say, the 10 years trading almost at 3%. So if you borrow at 0 and you lend at 3, it's a big spread. Multiply that by billions and billions and billions of dollars, and you're looking at very, very healthy looking balance sheets and cash flow. Now when the Fed has to exit this emergency Fed's funds rate, which according to the last Fed statement, it won't happen for a couple of years. But if, say, inflation ran and they had to really hike the Fed's funds rate, what the banks would be borrowing from at, say, 4 or 5% and lending at 3%, instant collapse. The balance sheet goes from billions of profits to tens of billions of losses, as well as the loss on the capital base, which is the actual toilet paper treasuries in the first place. And I've had this discussion before. It's just not the banks that's going to go. If the Fed tightens, not just the bondholders and the shareholders, it's going to be the depositors at the same time, because the Fed will not have any money for the FDIC, and the FDIC is the government agency which federally insures every dollar deposited in these big institutions. Well, if the Fed ever tightens, kiss the banks goodbye. This is just one of many things that's going to happen, but it's one of the biggest ones. Now imagine if you were in your old age, say in your 60s or something, and you had all your life savings in just these little CDs or just term deposits in a major bank, and the bank collapses and takes your deposits with you, and the guarantee or the monies that you have are no longer guaranteed by the government, you're gone. You're basically extinct. Now, that is just one of the many things that will happen if the Fed's funds rate was hiked. Now let's take a look at the other side of the equation, and this is the scarier part. It's the quantitative easing program and the aggressive asset purchases. Now, just for pure clarification, I've had a few emails over this. I said in a previous video that the Fed was actually not really purchasing 85 billion, and it was purchasing close to 100 billion. Now, the way to work it out is actually very simple. The Fed's balance sheet is $4.07 trillion basically today. Now, probably by the time this video is uploaded, it's probably has gone past 4.1 trillion. So if we look at what 4.1 trillion earns in terms of supposed interest, if you treat the average return across the entire Fed assets as roughly about 3%, or the 10-year, keep in mind that a couple of years ago, through Operation Twist, the Federal Reserve has changed its holdings to predominantly more long-dated bonds, so as to push the inevitable as far as possible into the future. Let's kick the can down the road so the next administration or the next Fed chairperson, good luck Janet, can wear the brunt of this impending crisis. So if we look at the return on that balance sheet as being 3% or thereabouts, then you're looking at an interest bill of roughly about 120 billion. And if you take that 120 billion and divide it by 12 months, you get approximately 10 billion. This is a very approximate number. Take into account that the Fed is rotating into long-term bonds, which are yielding much higher than that. Then you're looking at a monthly reinvestment schedule of probably close to 11, 12, 13, maybe $14 billion. So the Fed's balance sheet, including those dividend reinvestments, or I should say interest reinvestments, the government can't pay the interest, it has to print more IOUs. You're looking at a Fed's balance sheet increase of roughly about $100 billion a month. Now, if I confuse people by saying that the Fed was purchasing, it's not really a purchasing of extra bonds. It's just a reinvestment of those bonds. So all things being equal, you're still looking at a Fed's balance sheet which is increasing at roughly about $100 billion a month. And don't forget, all that interest earns interest. So it's not just simply calculated as $100 billion a month. That sequence geometrically grows every single month. Interest on interest on interest. So you're looking at, by the end of this year, asset purchases or asset reinvestments, provided that there's no taper, is easily going to probably exceed $110 billion a month. For those who don't know what $100 billion or $110 billion actually means in real life, I'll tell you this much: it's a lot of money. It is more than, well, it's almost 20% in Australian dollar terms of our gross domestic output, and that's huge. Actually, probably closer to 15%. Sorry. Now, that Fed's balance sheet of $4 trillion, if they were to unwind this quantitative easing and therefore sterilize those asset purchases, that means selling them, would you know what that would do to the bond market? Overnight. In fact, they wouldn't even have to sell them. They would only have to merely suggest that they are selling those bonds. And I can guarantee you, and the instant breakdown, shutdown, and collapse of the US Treasury market. In a nanosecond, people will realize that those bonds were worth less than toilet paper itself. And I can tell you, that day may be a little while away, or it could be within 2 months, who knows. But when you have debt, especially the American debt mountain, standing at 17 trillion, and it's growing geometrically, even quicker than the Fed's balance sheet, you're looking at a catastrophe beyond words. Now, if you think about what's been going on the past 5 years or so, the whole bond market has been manipulated by the Fed. If you didn't know that, well, I think you have to go back to the very first video. Because if the free market was allowed to reign, yields would skyrocket. Because we all know what interest rates are. Interest rates is the price of money. So as demand for money grows, which if you've got all this debt, yes, there is a huge demand for money, interest rates should skyrocket. When there's no demand for money, interest rates should bottom. Well, $17 trillion worth of debt, there's a big demand for that money. So interest rates should be much higher than the last 20-year traded average of, what was it? I read it somewhere, it was about 6.7% or thereabouts. My apologies if I'm a little off. But let's just say 6, 7, 8%, whatever it is a lot higher than the 3% odd on a 10-year. And this brings us to the next issue, which is the actual structural default of the US government. If you have a government that owes 17 trillion with an interest bill of close to 500 billion this year, based on a interest rate of 3%, then you're looking at a government that would be spending its entire tax receipts on trying to service the interest on all that debt. And we all know that's not going to happen. So by selling off these assets, the bond market is going to collapse, because the whole trade has been for people to buy these bonds and sell them to the Fed for a quick profit. which is totally against the whole concept of bond investing. Everything is speculating for capital gains, very, very quick buck. And if the Fed has been buying 90% of all the long-term treasuries, and if they stop buying, forget even selling, if they stop buying, who's going to be buying? And what's going to happen when they start to sell? It's going to be calamitous. So this unwinding or this exit strategy of the Feds will never ever happen under their own will. But the free market, through inflation and through all these debt holders finally waking up to the nightmare that is the ownership of these toilet paper treasuries, they will pull the plug first and the whole thing will be set in motion. I'm not going to get into it. If you've seen the previous videos, you'll know what I'm talking about. So next time you read or you hear about any potential unwind or an exit strategy, you know it's an absolute load of bull dust and it will never ever happen. So I hope that you can form your own opinion on this, and I hope that everything makes sense. And by the way, it's an absolute scorcher down here in Australia, and I wouldn't complain that much because our next door neighbour, Venus, is 500 degrees centigrade. And if that's not hot enough for you, there's a few exoplanets out there, so things like Osiris or HD 209458b, which have got surface temperatures of over 2000 degrees. So down here, what's the odd 38 or 40 or 45 degree day between friends?